In 1922, an American investor could buy a bond of the young Republic of Czechoslovakia, a paper promised to pay 8% a year for 96.5 cents on the dollar. Follow that one piece of paper. By 1928, men were paying $112 for it, 4 years of interest just for the privilege of holding it. By 1932, 67. By 1936, it had climbed back to 106. Then the war came for Czechoslovakia, and by 1939, the same promise sold for 6 cents on the dollar. In 1946, it rose again. Unbelievably, Graham writes, to 117, higher than it had ever been. 2 years later, 35. And in 1970, at the end of its half-century 8, the engraving never changed. The promise never changed. Only the hands changed. The confident study desk of 1928, the trembling vault of 1939, the attic box someone's heirs finally carried to an estate sale, and the buyer at nearly every one of those prices believed he was being reasonable. Graham kept that certificate story for one particular purpose, the top of his list of things an intelligent investor never buys. Behind the fourth door is a second job. Graham calls the person who takes it the enterprising investor, and before he says a word about the rewards, he posts the terms, because he knows what most readers actually want. They want something in between, a little more effort for a little more return, a middle path between doing almost nothing and taking up a profession. Graham's reply is one of the hardest lines in the book. The in-between course, he writes, is a compromise more likely to produce disappointment than achievement. And then the sentence that owns the fork. As an investor, you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits. Picture the shop that stays closed 6 days a week, opened only when its owner feels the itch. It still has rent, spoilage, and competitors who open daily. It has every cost of a business and half the attention of one. A shop run seriously earns a living. A shop run on Saturdays earns its owner a lesson. So the fork has 2 honest times only. The small dull machine from the widow's street, or this workbench and its hours. And for the reader who chooses the workbench, Graham begins. This is pure Graham. Not with opportunity, but with prohibition. Before the hunt, the forbiddance list, nailed shut above the bench. First drawer, the bond that pays a little more. There is always one for sale. In Graham's day, a second-grade bond paying around 4.25%, while the safest paid 2.5%, and Wall Street had a flattering name for buying it. The businessman's investment. Picture the buyer the name was coined for. A retired man at a kitchen table, his working ears banked, comparing 2 numbers a broker has written out for him. The bigger one seems the obviously business-like choice, and he likes being business-like. Graham's arithmetic is merciless on his behalf. For less than 2 extra cents a year on the dollar, that man stands to lose a substantial part of the dollar itself, the widow's temptation, wearing a businessman's hat. Second drawer, the Faraway Promise. Here the check certificate comes to rest, and it does not rest alone. Beside it lie the bonds of the Republic of Cuba, bought by Americans as high as 117, by men who felt pleasantly worldly signing for them, then defaulted, and sold for 20 cents on the dollar. Graham's objection is not geography, it is standing. When trouble comes, the owner of a foreign government's promise has no legal or other means of enforcing his claim. There is no court to walk into, no sheriff to send, only a piece of paper that can be honored, never collected. Third drawer, nailed twice. The new issue in a bull market. There is a season, mid-boom, when fresh companies bloom on the exchange lists, and Graham traces the cycle like a naturalist. The first offerings of the cycle are decent companies at fair prices. Then the market climbs, and the quality falls as the prices swell, until companies with no record and no substance sell on their first day for more, against what they earn, than the finest firms in America. The couple at the counter have seen the neighbor's issue jump, and the salesman lets them remember it. Graham answers with a shopkeeper's ledger. For every dollar you make in this way, you will be lucky if you end up by losing only 2. Then he adds the twist that turns the whole drawer into a treasure map. Some of these very issues, he writes, may prove excellent buys a few years later, when nobody wants them, at a small fraction of their true worth. Now the hunt. The first hunting ground hides in plain sight, and working it is almost insultingly dull. Take the 30 most established companies in America, the bluest of the blue, and each January, buy not the celebrated ones, but the handful trading cheapest against their earnings. The giants with a bad year, a lawsuit, a dull story. Hold, wait, resort, repeat. Picture the clerk who runs it. One January morning a year, the same 2 columns, the same pencil, circling whatever the market is currently embarrassed to own. His neighbors, holding the famous names, find him a bore. Graham had that drudgery tested across a quarter of a century, 1936 to 1962, and his tests found this: $10,000 rotated yearly into the Unloved Handful grew to $66,900. The same money spread across all 30 grew to $44,000. The bore beat the whole parade, because a giant out of fashion is still a giant, and fashion passes. The second hunting ground is the strange one. Sometimes, not often, but reliably in gloomy seasons, the market will sell you a company for less than the cash in its till, with every debt already subtracted, and the buildings, the machines, and the business itself thrown in free. The A&P in 1938 was exactly that one enormous, famous instance. Graham's discovery was that in the right seasons there are dozens of small obscure ones, and that the way to buy them is not as single bets, but as a crop. At the end of 1957, his list found about 150 such companies. He tracked the 85 with published data as one portfolio, bought at the year's end, held 2 years. It gained 75% against 50 for the market's industrials. 7 of the 85 stayed about even. 78 rose. And not one, his tests found, showed a significant loss. Buy a dollar for 40 cents, and if you buy enough different dollars, even your mistakes are made of money. None of this was theory. It was the shop's actual stock in trade. Late in the book, Graham quietly opens his own firm's files and declassifies the playbook it ran for 30 years. Buying paper that a merger or a reorganization had already promised to turn into something worth more. Whenever the gap offered, by calculation, 20% a year with 4 in 5 odds of coming true. Buying companies in the act of paying themselves out to their owners in cash. And always the wide net of till companies, at least 100 at a time, bought at 2/3 or less of their stripped-down cash value. The folders are just as eloquent about what they dropped. The firm tracked every class of operation it ran, found 2 that did not reliably pay, and cut them off, however clever they had felt. The boy from the bank counter kept that shop's books for 30 years, and the record they hold stands, by every later accounting, with the best Wall Street has ever seen. March 1964. A man buys a share of a plain little company called Burton-Dixie at $20. Inside the company, by its own books, sits $30 a share in net cash value, and about 50 of business altogether. A dollar for well under half. He has done the arithmetic twice. He locks the certificate in the drawer and waits for the world to notice. Christmas 1965. The world has not noticed. The stock is a stone. At dinner, a cousin is up 40% in something with Tronics in the name, and the man with the strongbox changes the subject. Spring 1966. He takes the certificate out of the drawer and runs the arithmetic again. Slower this time. The till has not leaked. The debts have not grown. The business is still there, still worth more than its price, still ignored. He puts it back in the drawer. This is the whole job now, checking that he was right and bearing that nobody agrees. 1967. Across town, the queue outside a certain gleaming fund office has never been longer. That is the year the hottest fund in America returns 38%, and the man with the strongbox looks, in public, like the one who got it wrong. Then, in August, a letter. The shareholders of Burton-Dixie are offered 53 3/4 a share. 3.5 years of nothing, and then 165%. Most bargains, Graham notes, do not take that long, nor pay that well. But the shape of the story is the trade itself. The return was earned less by cleverness than by the willingness to look wrong, in public, for years. The gifts exist for a reason, Graham states plainly. When Wall Street sours on a company, nothing counts in its scales, not famous brand names, not land, not buildings, not machinery, not the cash itself. That blindness is the enterprising investor's entire edge. He brought a scale of his own, and he can wait. Graham reaches past Wall Street for the verdict, to Pascal. The heart has its reasons that the reason doesn't understand. For heart, Graham says, read Wall Street. 2 Annis doors then. One holds a small dull machine and asks for nothing but self-command. The other holds a workbench, a forbidden list, a treasure map, and years of looking wrong. And it paid, in Graham's own shop, like almost nothing else Wall Street has to show. What the book will not bless is the third thing, the thing most people actually do. The middle path, half the work with all of the confidence, the shop open on Saturdays. Sure, it is being reasonable. There is one more room behind the workshop, and is the coldest one, because moods and impatience were never the worst of it. Some of the era's greatest disasters were not moods at all. They sat in plain arithmetic, in public filings, in numbers a clerk could have read, for years. While the professionals looked everywhere else, Graham performs 4 autopsies. The first is a railroad that had paid its owners a dividend every year since 1848.